Welcome to the deep dive. Today we're digging into, well, a really interesting puzzle in the tech services world. Accenture, ticker ACN.
Yeah, it's a strange one right now.
Definitely. I mean, look at the stock. It's down, what, over 31% this year? And
Yeah.
almost 40% off its high? That's painful.
Right. Numbers like that usually scream trouble,
Yeah,
fundamental issues maybe, or just the market losing faith completely.
exactly. But then here's the twist. Management just bumped the dividend. A solid 10% increase.
Yeah, which is a sign of confidence typically.
Totally. And the CEO, Julie Sweet, is basically saying their big bet on AI, that early investment, it's starting to work out.
So you've got this real contradiction. Bad stock performance, but the company itself sounds bullish. How do we make sense of that?
That's our mission for this deep dive. We can't just, look at the chart. We need to pull together two big perspectives.
Okay.
First, the macro view. What's the big economic picture? We'll use Ray Dalio's ideas about the economic machine to get a handle on the cycles ACN is swimming in.
And second, the micro. We got to look under the hood at Accenture itself. Apply some Warren Buffett-style tests, check out their financial health, their competitive edge, their moat, especially now with this huge AI shift.
Right. So let's start broad, macro. To figure out why a giant like ACN might be struggling despite looking solid financially, we need to understand the economic weather. Dalio's framework is really helpful here. He sees the economy driven by three main things.
That's right. First, there's the slow, steady climb of productivity growth. This is basically us getting better, smarter, more efficient over decades is what really makes us richer in the long run.
The bedrock, basically.
Exactly. Then you layer on the cycles that cause all the bumps. There's the short-term debt cycle. That's the one we're all familiar with, maybe 5 to 8 years long.
The one the central bank tries to manage, right?
Yeah.
Adjusting interest rates for inflation and growth.
Precisely. But then there's the big one, the long-term debt cycle.
Wow.
This beast unfolds over like 75 or even 100 years.
Wow.
Yeah. And it's defined by debt just growing way faster than income for a long, long time.
Yeah.
Eventually, it builds up huge leverage, asset bubbles. You know the story. It becomes unsustainable.
And driving all these cycles is credit. Dalio says it's key, but most people don't fully grasp it.
He really emphasizes it. Credit lets anyone, governments, people, companies like ACN, spend more now than they earn. It pulls spending from the future.
Creating growth now, but also an obligation later.
Exactly. You create this promise. Eventually, you have to spend less than you make to pay it back. Now, if that credit fuels productive things, like maybe ACN's AI investment leads to real gains, it's good.
But if it gets out of whack,
Then that long cycle ends badly. You hit a deleveraging. And this isn't just a normal recession.
like that.
Because interest rates are usually already slammed down near zero. The usual tool is gone. Debts are just too massive. Incomes fall. Confidence evaporates. It can lead to a lost decade. Real pain.
Okay, so what happens then? How does an economy get out of that hole?
Well, Dalio outlines 4 things that have to happen, usually in some kind of mix. The first 2 are tough. They're deflationary, meaning they pull prices down. First is cutting spending austerity. But that often makes incomes fall even faster than debt gets paid off.
Ouch. And the second?
Reducing debts. Think defaults, restructurings, also painful, especially for whoever lent the money.
So 2 deflationary punches. What else?
Third is redistributing wealth. Usually the government steps in, taxes the haves more to support the have-nots who are struggling.
And the fourth piece?
That's the controversial one, maybe. Printing new money. The central bank creates money out of thin air. This is inflationary stimulative.
Ah, so that's meant to balance out the deflationary stuff.
Exactly. You need that stimulus to fight the drag from austerity and defaults. It's a delicate balancing act.
And this is where different economic schools of thought really clash, isn't it?
Oh, yeah. During these times, you hear the Keynesians saying, government must step in, spend money, boost demand, get that multiplier effect going. But then the Austrian school folks argue, hold on, this whole mess started because the central bank messed with interest rates in the first place. Let the market clear. Very different views.
So putting it all together for ACN, they're trying to navigate this massive AI shift in a global economy that's potentially dealing with the fallout of a huge debt cycle, very sensitive to interest rates. It's maximum uncertainty.
It really is. And in times like these, investors get nervous. They might stick with truly dominant companies, but ones that look merely competitive, they get punished. Which brings us right back to ACM.
We need to look at their specific situation, their moat.
Let's zoom in. Let's put on our Warren Buffett hats. Buffett's idea of intrinsic value is pretty straightforward, right? It's all the cash a business is going to give back to its owners over its lifetime, discounted back to today's value.
Simple concept, hard to calculate.
Always. But we can look at indicators. Start with profitability. How good are they at actually making money? Let's look at the income statement.
Okay. Key metric, gross profit margin, GPM. What does that tell us?
GPM shows pricing power. How much is left after the direct costs of delivering their service? Buffett loves to see GPM consistently above 40%. That screams strong competitive advantage. They can charge a premium.
And ACN's GPM?
It's 31.90%. Now, that's okay. It's well clear of the 20% mark, which Buffett thinks means basically no real advantage.
But it's not 40%.
Nowhere near. And that gap tells you a lot about the IT services industry. It's just intensely competitive. ACN has scale, they have brand recognition, sure, but they don't have that fortress-like pricing power.
So they're competitive, but maybe not dominant in that Buffett sense.
Exactly. And that lack of dominance, that underlying competitive pressure is probably a big reason the market is hitting them so hard now, with all the economic uncertainty swirling around.
Okay, so the GPM shows the pressure, but you mentioned the dividend hike. That confidence has to come from somewhere. Let's look at stability of the balance sheet.
Ah, yes. This is where ACN looks really strong. This explains the dividend. Their debt levels are incredibly low.
Well,
The debt-equity ratio is just 0.26. Long-term debt equity is 0.24. That's rock solid.
meaning they basically fund themselves.
Overwhelmingly, they don't rely on borrowing to operate. That's a huge plus, a sign of real financial strength that gives them options.
Like hiking dividends and funding massive projects. We also looked at retained earnings, right? Money they keep in the business.
Yeah, and ACN's retained earnings have shown consistent growth. That's another classic Buffett sign of a durable business. They're generating profits and reinvesting them effectively over time.
And cash flow. That's crucial too.
Absolutely. Their free cash flow, FCF, is impressive. They reported $4.48 billion. And get this, that's up almost 43% year over year.
43%. Wow.
Yeah. So when we do the CapEx test, looking at how much cash they have to spend just to maintain the business versus how much they earn, this huge FCF suggests they're very efficient. They're throwing off a ton of extra cash.
Cash they can use for, well, for that huge $865 million AI restructuring charge and that 10% dividend hike.
Right. Bingo. You've resolved the contradiction. The dividend hike. That's management flexing its strong balance sheet. They have the financial muscle.
Oh, the stock drop.
That's the market looking at the competitive landscape, looking at that 31.9% GPM and saying, okay, you're strong, but can you really pull off this massive, risky AI transformation fast enough to protect or even grow those margins in this tough environment? It's execution risk.
So now we have to zero in on that risk. This AI investment isn't just tweaking things. It's a fundamental shift. How do we think about the risk involved?
Well, you can connect it back to financial history. Think about Minsky's hypothesis.
Remind me.
Minsky basically said that long periods of stability actually encourage people, managers, companies to take on more and more risk, maybe excessive risk. Stability breeds complacency, then overconfidence.
And ACN has been a stable cash cow for years.
Exactly. So now, faced with this huge technological threat or opportunity, depending how you see it, they're making a massive bet. $865 million, huge internal changes. That's a big swing.
And the market picks up on that risk. We see it in the beta, right?
Yeah, ACN's beta is 1.26, which means statistically it tends to be about 26% more volatile than the overall market. It moves more dramatically up and down.
But beta has limitations, doesn't it? Especially now.
Big time. Beta assumes the relationship between the stock and the market stays pretty constant. But when a company undertakes a radical strategic shift like ACN is doing with AI, that historical relationship might completely break down. The old beta might not tell you much about future risk. It's a lagging indicator.
So what do quants use instead?
Often they prefer the Sharpe ratio. It's a bit more nuanced. It measures the return you get specifically for the amount of risk or volatility you took on. Better return per unit of risk is good.
And with ACN's pivot, the market just doesn't have enough data on this new AI-focused ACN to feel comfortable, leading to higher perceived risk and volatility.
That's a big part of it. And you can't ignore the human element here, the cost. It was all over the news.
The layoffs.
Yeah, the earlier big layoff, and then the reports about actively exiting current employees who couldn't adapt or be retrained for AI quickly enough. That tells you how seriously and how rapidly they're forcing this internal change. It's disruptive, it's costly, hence that $865 million charge.
It's a real transformation, not just talk. And this kind of huge forward-looking project bumps right up
Yeah.
against our own human biases, doesn't it?
Absolutely. Think about epistemic arrogance, that tendency we all have to overestimate how much we actually know, and the planning fallacy.
Which is?
We tend to be overly optimistic about how long things will take and how much they'll cost while underestimating the risks. We get tunnel vision on the goal.
So ACN is trying this massive project, and we as observers, and maybe even they internally, are prone to thinking we understand the past better than we do.
It's a real danger. One of the sources made a great point. Truly radical innovations, like inventing the wheel, are basically impossible to forecast because the forecast itself would require knowledge from that future. ACN is stepping into that kind of unknown with AI. The market uncertainty reflected in the stock price makes sense in that context.
Which brings us back to volatility. Tools like technical analysis try to make sense of price moves, looking for support levels where buying might step in.
And resistance levels where selling pressure caps the price. A strong break above a resistance level could signal that the market is finally starting to believe in ACN's AI story.
But until then, it's likely stuck in this volatile range, reflecting that fundamental uncertainty.
Right. So let's bring it all together for you, the listener. What have we found? ACN seems financially very sound, low debt, lots of cash flow. That justifies the dividend boost, signals internal confidence. But they operate in a really tough competitive industry. That 31.9% GPM shows it. And the stock is getting hammered because the market sees significant risk. The 1.26 beta is one indicator in whether they can actually execute this massive, expensive, and kind of unpredictable AI transformation successfully, especially in this tricky macro environment.
It's a financially stable giant facing a potentially make-or-break moment. Which leads us to a final thought, connecting back to Buffett and those ACN employees.
Yeah, Buffett has this great quote about habits. He says, "The time to build good habits is when you're young." Why? Because the chains of habit are too light to be felt until they're too heavy to be broken.
So the old ways of working, the skills that were valuable yesterday.
For some at ACN, those became the heavy chains that couldn't be broken quickly enough for the AI era, leading to their exit. It's harsh, but it highlights a critical point for everyone.
So the final question for you isn't just about ACN stock, it's personal. What professional habit, what skill, what area of learning are you building right now?
What light chain are you forging today that will be your strength, not your burden, when the next wave of technological change inevitably arrives? Something to really think about in this AI-driven world.
A powerful thought to end on. Thanks for joining us for this deep dive.